JF Technologies Berhad was founded by Datuk Fong Wei Keong and Dating Wang Mei Ling in 1999. The company is one of the original design manufacturing players, specializing in making test socket. Their products are used to test and screen microchips for major companies in the mobile and automotive industries. Their clients include BMW, Samsung, Canon, Ford, Dell, and most definitely Huawei. Some of the countries they sell to are Malaysia, which represents about 24.6% of their total revenue for financial year end 2020. 34.4% comes from China, followed by the USA 10.7%, Taiwan 6.2%, Philippines 9.3%, and the remaining 14.8% is from other countries. For more information, you can visit their website at www.jftechnology.com. With the company's ODM status, it's no surprise that their gross profit margin is high. The number will be disclosed in the next slide. More importantly, sales and gross profit have been rising in tandem over the years, contributed by large demand for their test contacting solutions from the OEM customers. However, in the early years, revenue and gross profit fell as a result of a weak global market condition in the semiconductor industry. An inconsistent movement in their operating profit. That's because the company had incurred a high legal fees since 2014, as well as low demand for certain products stated in the slide. Fortunately, operating profits start to improve in financial year end 2020, thanks to lower legal fees and more gains in sales and other income. As mentioned in the first slide, their ODM business allowed them to command a high gross profit margin, sitting at above 70%. A turnaround from negative OPM and NPM to positive, showing the fruit of enhanced productivity with the improvement in sales and well-managed operating costs. I have decided to add return on invested capital or ROIC in my analysis thanks to a viewer's suggestion. Why ROIC? Because it gives a sense of how well a company is using the money it has raised externally to generate returns. In simple terms, ROIC shows how much cash is going out of a business in relation to how much is coming in. It is especially useful when evaluating companies that invest a large amount of capital like oil and gas and semiconductor chips companies. In the case for JF Tech, it is considered remarkable though inconsistent. Most likely it's because of the high legal fees incurred since 2014. In terms of remuneration to PAT, I'm not a fan of how the management overpaid themselves with the unstable PAT delivery over the years, unless the company has big plans to generate more sales and profit in the coming years. Very healthy cash to total debt ratio, sitting at a net cash position for 9 years, plus cash is growing. Not to mention, the company is actively trimming down their debts. On top of that, the company has a relatively healthy cash flow, above their CAPEX almost every single year. However, the growth is choppy due to the unstable inventories and receivables turnover. A steep fall in operating cash flow in financial year end 2019 as a result of a large trade receivable incurred during that year. The dividend payout is alright, but I must commend JF Tech for not declaring any dividend during the times when they are incurring losses, because many companies will find odd ways to pay dividend to make their yields look good. Also, another inconsistent free cash flow growth, although it's good considering not many companies can sustain positive free cash flow over the long run. No problem with their dividend payout as JF Tech has ample of cash reserve in their company. All in all, I rate their company 5.4 out of 8, which is about 67.5%. Not too shabby financial performance. Overall, it's good, but it would be great if the management reduced their remuneration payout. Though this can easily be offset if they can deliver better results in their next financial years. After analyzing JF Tech's 10 years of financial data, here are my thoughts about them. Number 1, the company will benefit a lot if the US-China trade war continues to prolong in line with less competition from the US and more business collaboration in the Northeast Asia region. This is justified from their recent business partnership with Huawei. Although JF Tech has moved on from their patent infringement lawsuit from Johnstech in 2019, I foresee it may happen again if JF Tech is not careful with their design, especially those without patent. Take Apple and Samsung's 7-year-long patent fight over design plagiarism as an example. Lastly, JF Tech needs to improve on their working capital, especially trade payables, to keep up with the ever-growing trade receivables in order to achieve a healthy cash flow. So that's all folks. If you enjoyed the analysis, make sure you smash the like and subscribe button for more. If you have any questions, feel free to comment down below. I'll be happy to get back to you. With that, I'll see you on the next one.
Fearless.